Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Welcome, everybody. It is June 6th, 2025. We have Jeff Swainson, CEO of Simply Solventless, with us today. Simply Solventless trades under the symbol HASH.V on the Venture Exchange. Currently has 108 million shares outstanding, closed at about 18 cents, I think it was, so about a $22 million market cap. We're going to forego the typical sort of quick business snapshot. I think we're going to dive into sort of the recent happenings right away. We're going to be a lot more proactive with everybody. I know there's going to be a lot of questions, so we want to get to those as fast as we can. But maybe Jeff, I'll turn it over to you. Maybe let's talk about kind of the recent happenings and how they came about and any details you can give us, and then we'll jump into questions.
Sounds good, Paul. Thank you. Thanks for having me. And so ultimately, obviously it's been quite the whirlwind the last few weeks here. Up until essentially very late April, we had expected everything was on course. I had flown to Toronto. I was on the way to Toronto on the 27th of April, and we were even drafting the press release that guidance was coming in on target or even better than guidance. And then when I landed in Toronto, things started to change. We had become aware of a couple issues with the audit. The first one being related to taxes with the Canmart Inc. acquisition. And then it kind of just evolved from there. The next day after that, we had the notice from our auditor that the audit would be delayed, that they needed more time. And, ultimately we had a couple delays there and filed this week, as everyone I'm sure is aware. And so ultimately, I'll go through the high level accounting issues that we encountered, and why it took us by surprise, and then kind of how it's going to affect us going forward. So ultimately the first issue that we came across was that tax issue, and ultimately it turned out to be relatively a non-issue. We pursuant to the Canmart Inc. acquisition, of course, we had expected, we were acquiring about 22 million worth of tax pools, and Canmart had done a reorganization around the time of the Canmart Labs CCAA, and the effect of that ended up being that there was some large intercompany balances between the parent Lifest, Canmart Inc. and Canmart Labs. And the way that they structured around the CCAA meant that there was a large gain on the extinguishment of this intercompany loan amount, which meant it was a taxable transaction in the eyes of the CRA potentially. And ultimately, there was a strategy in early Q1 to mitigate that, and we believe that it's a valid strategy, but ultimately the auditor took the position that we would book a provision for a potential tax liability. We ended up booking a provision of about $400,000. But the main issue is that it ground the pools down potentially. I mean, we believe that the way it was handled should result in no liability. But should the CRA come, then it would be a grinding of our tax pools and a small liability. But from there, I think the more important and material issue is the revenue recognition. So essentially from that day forward, we encountered these challenges, and so the revenue recognition item relates to tolling services that we perform for customers where we get paid in product rather than cash or receivables. So essentially what would happen is a cultivator would send us flour, large amounts of flour. We would process it, and as payment, we would take bubble hash in kind. And the accounting for this is pretty straightforward. It's you debit inventory and you credit revenue. And we've done these deals for over 2 years. We had audited statements in 2022, 2023 with the exact same treatment. And ultimately, a very subtle change that we made to those arrangements resulted in the auditor taking a different view once we had gotten into the delayed filing of our financials. And at the end of the day, essentially we had to remove the revenue and treat it as a supplier relationship, which was quite challenging for us because we've done these deals for so long, and there's clear commercial benefit to these deals. We did these deals back starting in 2022 when we had no access to capital. We had no capital, and we needed a way to basically build our business, build our balance sheet, put inventory in our vault so that we could pursue provincial listings on a CPG sales strategy, with inventory that we didn't have to pay for up front. And so the deals were great for us over the years, and continue to be very commercially advantageous deals. But of course, the accounting treatment changed drastically. So the accounting treatment, whereas before the rule is with IFRS, when you complete the process, as I said, you book it to inventory and revenue, and you do it at fair market value, and that's the standard. These types of deals are done in all types of manufacturing industries. They're not atypical by any stretch of the imagination, and certainly we're not the first cannabis company to do these types of deals. And so ultimately, when we're selling hash to a CPG, to a province, be it Alberta or Ontario, whatever the case may be, ultimately we monetize a gram of hash for a certain price. And I'll just use the $10 as an example. And so under IFRS, how it would work is you would basically start with nothing. You would put labor and fixed overheads into this project where you're doing the processing of the flower, and then you end up with the hash. And so the first step is that you would book it in at something between $0 and $10. IFRS says fair market value. And so the number that we used is somewhere below $10. Of course, it was typically around $7 or $8. And so then when we then sell it to the province, there's an incremental amount there that's booked. At the end of the day, it's still the same $10 that you're getting from the province, or $12 that you're getting from the province. It's just with these types of arrangements, it turns into a two-step process. Number one, where you're earning the inventory, and number two, where you sell it through to the customer. And so at the highest level, what happens when you treat it as a supplier relationship is that the cost base of the inventory comes down quite dramatically. So whereas before, if we were selling a gram of bubble hash for $12 and we were booking it on the in-kind transaction at $8, that differs because in the supplier relationship, you're just booking it for essentially the cost of that material. And so in these cases, the cost of that material in an in-kind relationship would be how much you're essentially giving to the counterparty. And so how it's all shaken out here for us is that the cost base of the bubble hash now is going from $8 on our books to $2.35 roughly. And so as a result, when we sell it to the provinces, we're still getting the same selling price, but the cost is now $2.35 instead of $8. So the margin is much higher on the sale to the province. It doesn't have that two-step process where you're first booking it into inventory at $8 and then selling it for $12. And so I know it's a bit convoluted, and it's hard to get into the granular bits of it, but at the end of the day, what it's doing is taking revenue and margin from one period and just putting it into future periods. And so, whereas before, the total margin, $12 minus the ultimate cost, is the same whether it's, booked in 2 steps or 1 step. When we do our margin analysis on the, going forward through 2025 with the cost base adjusted how it is now, it's, the margins are very, very attractive for us going forward. So, so that's the first component. There's the revenue recognition in 2024 and the inventory balance. And so when we wanted consistency through the accounting periods, through the prior periods. We wanted comparability since we've done these deals for so long. And so, we had intended and desired to restate 2023 to have the new treatment as well in the accounting so that there was comparability. But then it turned out, sure enough, nope, we can't restate 2023. We were essentially out of time. And so what happened is 2023, the cost base of our inventory was at the $8. And then when that inventory was sold in 2024, it would be going through cost of goods sold at $8, whereas the revenue in 2024 was totally eliminated. So we had this doubling up effect of lower revenue and higher expenses because the same accounting treatment wasn't applied to the prior period. And so going forward, it essentially reverses itself out. And so we have the lower cost base now going, as I said, into 2025. And, so essentially we're going to have higher margins on our CPG products. It'll be the same total margin, but we'll have the same margin at the point of sale, essentially. And essentially all of the reverse revenue is going to come back onto our books through this year. And so, I know there'll probably be questions about that. It's kind of hard to even know where to start when I'm explaining these things on the revenue recognition side. But ultimately, we had a double whammy, so to speak, where our revenue was significantly reduced, which was inconsistent with the prior periods, and then our COGS, our cost of goods sold, was elevated due to the old accounting method. And so both of those obviously had a pretty drastic impact to our P&L.
Okay, perfect. Thanks, Jeff. Again, a reminder, everybody, please, with your questions, we can do 2 things. If you guys want to unmute yourselves for the question, that's great. Otherwise, use the chat function inside Zoom, and we can ask a question that way. I've got a couple questions that have come in from somebody else, so why don't I just start with that, Jeff? First question, and I'm seeing it for the first time myself, so I'm just going to read it here. Does Jeff agree with the auditor's decision to change how tolling revenue is recorded? If so, why?
Yeah, and that's really tough because I don't want to, sit here and speak negatively about anybody or what's happened here. But we certainly believed that we were accounting for this in the appropriate manner. It's a manner, as I said, that had been audited numerous times. And there was a subtle change in one of the aspects of the deals that happened that resulted in this changing, and maybe the whole situation impacted it as well. And so, I believe, personally, it should have been accounted for how it was before, but it wasn't, and we're kind of left with that. We're trying to see the positives and how it might impact us going forward positively. We do have, the much lower cost base on our inventory now. We can more aggressively pursue the B2B markets. But ultimately, I certainly wish that we would have continued with our accounting treatment that we had for several years to avoid, a disruption. Because when you have an accounting policy and it's in place for years and over multiple periods, everything is smoothed out. It's just all, turning over. But when you have a drastic change in your accounting policy like this, particularly when it's not applied to the prior period, it really puts a lot of volatility into the profit and loss. And so I know that's a long way to answer your question there, but certainly we saw a lot of validity in maintaining the accounting treatment that we had previously.
Mm-hmm. Gotcha. Okay, so next question I have here is, does Jeff disagree with the auditor's decision to add more overhead costs to inventory/COGS? If so, why does he believe these costs should not end up allocated to inventory/COGS?
Yeah, and so that's another thing that's just typical in manufacturing operations, where direct costs are allocated to inventory, and then once that product is sold is when it goes through COGS and is expensed. And so this came up very late in the audit, that this other adjustment. And when we looked at it at a high level, we were of the belief that we were expensing more than we likely had to. We had expensed about, and so if you look at the whole year in aggregate, we had expensed about 20% of the units we produced, but we only sold 15% of the units we produced all year. And so we thought that we were ahead of the curve and expensing quicker. And so but by that time, honestly, we had thrown our hands up, so to speak, on the revenue recognition issue and said, okay, let's do, we'll change our accounting treatment on the revenue rec. Please, let's do it in 2023 as well. Nope, we're not going to do it to 2023. Okay. So by that time, we were almost okay. If you want, if we're going to take if we're going to push more of the allocated overhead and labor into COGS, so be it. We just went through it. In our perspective, again, it's just moving costs from one period to the other. It's going to reduce the cost of goods sold going forward, in our view, of course. And so it came down to a point where we just had to file. We couldn't continue to delay our financial statements. We needed to get them out. We needed to move on. We needed to continue to run the business, and so by that time, my views or our team's views on the cost of goods sold and what was being put into cost of goods sold, had our views maybe weren't as important as they once were.
Mm-hmm. And I'm going to apologize in advance. There's likely to be a lot of duplication of questions, so it might sound like I'm asking them twice, but I'm just reading them for the first time, and I just want to ask them here. Okay, so continuing on with this one. Not sure if Jeff can talk about specifics around Q1 cash flow and total cash at the end of the period, but can he at least talk to the company, or if the company was cash flow positive in Q1, how much cash they had available at the end of the quarter, or have available now, and most importantly, how confident is he that they have enough cash to self-fund operations for the next few quarters if no outside funding is available?
Yeah, and so that's been one of our key focuses here, before even these issues, is cash flow from operations. And so, given we've been, acquisitive and we closed, several acquisitions, as I'm sure you're aware, in 2024 and even early 2025, it's been a bit hard to gauge exact cash flow from ops and non-recurring costs and things like that, but it's our absolute focus. As a consolidated entity, we've essentially had a month of cash flow positive, a month negative, month positive. We're still rationalizing our asset base, and there's some further rationalization that can happen. And so I guess, what I can say is that going forward, cash flow from operations is one of our primary focuses. It's to generate solid cash flow from operations, but, be self-funding. Obviously, with our cost of capital where it is now and our share price, it makes it a lot harder to do deals. They become a lot more expensive. And so, what we really want to do is generate cash flow from operations, by the exit of 2025, demonstrate that we're doing that solidly, that's our focus, that we're cleaning up our balance sheet, and becoming as clean as possible in that regard to help to ultimately drive some trust, and and show people that, you know, the infrastructure that we've built over the last year is very meaningful, and that we're able to capture the opportunities that it brings.
Perfect. Thanks, Jeff. Okay, so we'll go into the chat here in the questions. Chris, there's a couple that have sort of been answered, so I'm going to jump through a few here. Chris says, what was the underlying issue that caused the 3.1 million in overheads to be missed or unaccounted for, and how will this issue be managed going forward?
Yeah, and so it's tough because it wasn't really missed. I mean, it had been audited early on in the audit. It had been, you know, it had been there the whole time, and you know, I just think as things evolved throughout the delay in the audit, it just kind of grew and grew, and maybe, you know, maybe the risk to the parties involved was, you know, seemingly higher and higher, and so, you know, like I said, from our perspective, we had been ahead of it. We had been expensing enough of the capitalized overheads. At the end of the day, you know, the auditor came with an analysis, and it was a very high level analysis on, you know, kind of what they thought the ending capitalized overheads should be, and as I said, by that time, we didn't have time to even necessarily prove otherwise. We were just out of time. We had to get filed, and so we essentially accepted, you know, the high level analysis, and elected to be conservative, and take that amount through cost of goods sold.
So do you expect that to sort of unwind itself, or the opposite to happen over the course of the next several quarters? Is that how this should be viewed or
Yeah,
expected?
exactly. So whereas before, if, you know, if it wasn't written off, that $3 million would have been expensed as we sold products going forward. So the expenses going forward would have been higher than they will be now. So just as, and I'm using just very rough numbers, but say, you know, say when we sell a gram of product going forward, or say with the current balance, say it would have been, you know, $2 allocated to the product when it was sold. Now, since that balance is by half, only $1 would be expensed through COGS when it's sold. So the cost of goods sold will reduce over time, you know, going forward into the future periods, and the revenue will increase commensurately with the revenue accounting treatment change. So
Yeah.
now going forward, we'll have a double whammy the other way. And so it'll unwind itself over the coming periods. I'm not sure exactly how many periods, but I wouldn't anticipate it would be that many, to be honest.
Okay, and this is an interesting part of the question too. Also, what percentage decrease in profit margins would you expect this previously unaccounted for expense to contribute going forward, and why? You just basically said the opposite is going to happen.
And then there's
Profit margins are actually going to increase going forward because of this sort of accounting adjustment.
exactly. And so, like, if you look at our gross margin for 2024, 13%. We don't sell product for a 13% margin. We just don't, like, in my view, we don't have a 13% gross margin. The reason that it's presented as a 13% margin is because we have inventory that was booked in the old accounting treatment from 2023 that's being pushed through cost of goods sold at 3 times the amount that our current value of that product is. So we have elevated cost of goods sold in 2024 because of the accounting policy isn't consistent with the prior period, and then of course the revenue is completely gone. So our margin, you know, is presented as 13%. But when we do our economics on our products going forward, especially with the new cost base, so before we would perform the tolling services, we would get paid in the inventory, we would book margin on that, and then when we sold it to the province, we would book essentially another 25 to 40% gross margin, like an incremental gross margin when that sale took place. Now, when we do the economics with the new cost base of inventory, we're looking at, you know, if the landed costs, and so if the revenue per unit is the same and we don't reduce our prices, which we actually could do going forward, our margins are showing, you know, literally 50 to 70% on these products now, the same products. So overall, the margin is the same, all things being equal. It just, it's booked in different times, the margin. But now going forward in this year, we expect our CPG margins to be very high, higher than ever. And so overall, we should see a corporate gross margin analogous to what we were presenting up until now, up until these adjustments were made. Because the overall corporate gross margin in going historically, call it 40 to 50%, was accounting for the margin booked on the in-kind tolling services and the CPG margin. And so now it's still going to just be it's going to be the same overall margin. It's just all going to be at the time of the CPG sale instead of the incremental step. And so our margins over, once they should, in my view, they should be in that 40 to 50% range.
Yeah.
Corporately.
Okay, good. Yeah. I think it's an important piece to understand, and hopefully, Chris, that answers the question. Chris, if there's any follow-on after that, please just use the chat function again. Okay, so Paulo asks a bit of a personal question here, I guess. Would you be buying the stock if you weren't in MCTO right now?
Unequivocally. I really wish that we were not in an MCTO. That was, it's been a bit of a frustration because obviously we can't buy the stock and we believe in the stock. I mean, we're all very heavily invested. The value creation is why we're here. We're not doing this for the big salaries, so to speak. And so as soon as we can, I'm going to explore how I can invest into the company more. And honestly, I'm even considering taking loans against my shares and putting those proceeds into the company. Just to make sure that the company has as much capital as it can, and to demonstrate how committed I am and our management team is to our story and what we're doing.
Awesome. Okay, Greg asks, when do you? I'm sorry, I missed one here. How do the accounting adjustments affect the Q1 guidance published before?
And so we're working through that right now. So we did do a bit of the in-kind tolling in Q1, but then there's other things that are, like the cost of goods sold changes, everything like that. So we're kind of in the middle of just making sure we fully understand those changes. If I was put on the spot, I would say, my belief is that it wouldn't be materially different from guidance. But of course, there could be some differences there. But, as I said before, these changes start reversing themselves out in the future periods, with Q1, of course, being the first period. And so we're working through that now. We are in a bit of a atypical situation now, though, in that the commercial agreements that we have don't agree to how we've accounted for this. So, that's something as well that we're working through, that we have worked through even in the past before these issues came up, but where we need to kind of align everything now with our counterparties.
And maybe explain that a little bit more. What do you mean by align yourselves with counterparties? And
well, for example, these counterparties think that they own part of this inventory, and now the way that it's been accounted for is that it's essentially accounted for as if we just purchased all of the flour to process ourselves, and now we own all of the resulting inventory. And so that's not a risk in terms of we're going to have to turn around and give them inventory, but it's just now we need to make sure that all counterparties and the commercial agreements agree to how this accounting treatment has been essentially pushed onto us.
Gotcha.
So it's a situation certainly that I've never seen in my career, and it's something we'll get through. It's not going to be a significant issue. We'll get through it, and it's just a matter of working with our customers. I call them customers. The auditor calls them suppliers, and aligning and then also making sure that we're going forward we're entering into contracts that make sense, that everyone knows how it's going to be accounted for and things like that. So
Gotcha. Perfect. Okay, Greg says, when do you expect to become cash flow positive?
I would think that Q2 Q3, Q4 is when we're really targeting. We want to be strongly cash flow positive. One of the ironies of the situation that's happened is because of that lower cost base, I think I mentioned earlier, we can more aggressive, like, so before, whereas we would get paid in inventory and we'd book it at the $8 as an example, and these numbers are examples. We wouldn't aggressively pursue the B2B business. So this, these commercial arrangements that we entered into were entered into because, as I said, we had no access to capital. We had no capital. We were a struggling cannabis company, and we needed a way to build inventory without paying for it out of pocket. And because of that, and because of the accounting standards and how it's booked in that event, you have a higher cost base. So this strategy was designed purely for CPG sales, because we would know that we would have incremental margin above the amount that this was booked in at. So we wouldn't pursue B2B transactions because our cost base was too low. Well, now our cost base is low, and so it really opens up the B2B market to us overall. And so I guess ultimately at the end of the day, what the effect would be in my mind is that we sell all product for a margin, including in B2B, and the changes in non-cash working capital, whereas they've been negative before when it comes to building inventory, which is kind of what our intent was early on with these deals anyways, is to build the inventory to make sure that we can aggressively attack these CPG markets. Now, I would think that, we at some point this year we'll see a turn in the changes of non-cash working capital to where the monetization of the inventory is contributing to cash flows rather than taking away from cash flows. So that's how we see it. The cost base, the kind of where we've landed here, allows us to pursue more markets and monetize more inventory quicker.
Gotcha. Okay, another question from Chris. If your depressed share price causes acquisitions to be mathematically unattractive, what is your plan to manage the business going forward, particularly from a solvency perspective and overall business plan?
Yeah, and so, obviously we've been managing our cash flows very close, and we've been obviously evaluating our asset base and understanding where we might be able to save costs, be as lean as possible. We've always been lean, and that's always been a significant mandate of ours. But we're looking at a lot of different opportunities to kind of operate within the infrastructure we have and to build the business with what we do have. ANC Inc., they're rolling out a co-manufacturing operation in Ontario in our Canmart facility. And so, they're doing fantastic, but we do find that the Ontario market is a lot harder for us to penetrate, being in Alberta with ANC. And so we have a Canmart facility there, sitting there. It's being turned into pure 3PL. So we were going to shut that facility down just to be like, and try to rationalize it, save the cost, move its operations elsewhere. But we started to see a lot of benefits of having that facility in Ontario. And the main one being that ANC, as I said, is now they're opening a pre-roll contract manufacturing and vape filling contract manufacturing operation there, to where they can capture consumers that need local proximity. It shaves a few days off the shipping times, whereas before a customer would have to ship their flower to Edmonton, have it processed, then be shipped back. Now it's a local facility for a lot of these customers, and so we're looking at opportunities like that. We're looking at continued, obviously, rationalization within our facilities, and potentially even looking to shut one facility down at some point in the future. And so operating within our current infrastructure, making sure that we're focusing on sales as much as possible, and capturing opportunities like we are looking to do in the Ontario market with the contract manufacturing, are some of the ways that we're doing that.
Gotcha. Thank you. Okay, Greg says, how long does it take to sell the product after it was produced, / tolling?
Yeah, and so that varies. I mean, typically, 2-3 quarters is kind of the turnover rate on that inventory. And so how things look going forward, we're going to have to look. There's incremental markets that we can attack with a lot of the customers as well that we're already pursuing. For example, we're not in BC. And so we believe that we can, increase the velocity with some of these customers that we had by using their brands into BC where we're not in. And so, it's essentially, a 2 to 3 quarter turnover of our inventory. And I think really that's represented in the numbers. If you look at our, some of the figures we provided previously, we started at something like a 0.5 inventory turnover, and it went to 1.2 times per year, I believe. And so we've cut our inventory turnover, times, or we've increased the velocity of our turnover quite substantially, because I know that, that's something that everyone was keeping an eye on, and it was certainly important to us to ensure that we have the cash flow. And so, yeah, it's something where we're going to continue to do all we can to reduce, to maximize inventory turnover, essentially.
Mm-hmm. Do you intend to continue accepting in-kind compensation for tolling services and recognize revenue for selling that product in the future, or will you prioritize cash-based tolling going forward?
Yeah, and that's exactly it. That's a very, very interesting observation, because the difference is that we can do so look at ANC, for example. 80% of their business or more is regular tolling, right? So the only difference really at the end of the day is that it's credit revenue, debit accounts receivable or cash, instead of credit revenue, debit inventory. And so we were already switching to those agreements, actually, in some cases. And so we'll continue to go down that path rather than the in-kind commercial arrangements, just because I think it gives more certainty to our accounting treatment and everything like that. And I mean, I'm the last person that, that sounds like tail wagging the dog is, but here we are, right? We've encountered a significant disruption to our business and to our business plan because of that. And so, of course, going forward, we want to do, our commercial arrangements in a manner that aren't going to result in any volatility like that. So I would say, yes, we would focus more on regular tolling arrangements like we do in a lot of our business units already.
Mm-hmm. Gotcha. Okay, Flobertus asks, what is the $3 million overhead? Is it energy cost, personnel, or something else? Was this capitalized related to CapEx or related to treatment of agricultural assets, or for a different reason? Are these costs that have a useful life over a year?
And so those costs are direct labor, direct overhead, direct facility costs that are spent in order to produce inventory. And so in a manufacturing operation, you're supposed to, and it's kind of ironic because I'll give some insight to this in a bit, but you're supposed to capitalize all directly attributable costs. And then when you sell the product that you produced, it comes into cost of goods sold at that time. So that's what those costs are related to. Those are directly attributable, predominantly labor and overheads like utilities and things like that were capitalized to the inventory, and then that came out of inventory when that was sold, and that's when they hit cost of goods sold. And we had even said, okay, well then just impair all of that stuff then. And then they're like, no, you can't. You have to capitalize it. So, so we ended up with a balance in there still, because, it's the rule that you have to capitalize the directly attributable overheads and labor.
Okay. Okay, Russell asked, do these accounting changes affect how much excise tax or income tax you pay?
No. I mean, other than so it depends on the tax treatment of the in-kind tolling arrangements. So, if those were taxable, then, which I don't believe that they would have been taxable, and it would be when the product moves through and is sold, the resulting product is sold. It won't affect excise. only to the extent, as long as our prices are the same. If we keep our prices the same on our CPG products, then we'll pay the same amount of excise. And then in terms of income tax, it shouldn't have an effect on income tax.
Mm-hmm. Okay, perfect. Okay, Chris is asking, was the approximate 3 million increase in amount owed to ANC a previously determined earnout or a restructuring of the overall deal? What similar expenses are on the horizon that you expect Hash to incur?
Yeah, no, and that's a great question. And so the prom notes to ANC it was 3.65 million due May 31st. And then it was a maximum of 3.5 million due October 31st. So those combined, we owed ANC former shareholders 7.15 million max. And so what we did is we at the highest level, we settled the earnout today that we had to pay the earnout anyway. So we settled it today. And then the former ANC shareholders essentially took half of it in shares today at 50 cents per share. And then we rolled the remaining into one prom note balance and are paying it 1 million in just over a year, and then the remaining over 24 months. So all we've done is we've taken the total prom note balance, actually reduced it by about 6.6 million that we're going to actually pay now total. And we've paid it in shares at 50 cents and then rolled the rest forward. So we didn't just add on a bunch of additional consideration or anything to ANC. We just restructured the existing 7.15 million of prom notes to be 3.4 million paid in shares and the rest deferred over 2 years, essentially.
Mm-hmm.
So for us, I mean, we look at that. So the ANC had 5 former shareholders. One of them had 43% of the business. He took $1 million of prom note, but the rest he took in equity. He took about 2.5 million in equity at 50 cents a share. And then the other party that's not involved with the business anymore, he took 100% equity. And the 3 that are still working with us, Terrence Rutter, Thomas Facciolo, and James Clark, they're on the 2-year deferred plan more. And so, it was very interesting because, obviously they were well aware of the challenges, the MCTO and delay and everything like that. And all of a sudden I got a call from the 43% prom note holder that he wanted to basically do all equity at that time. And so, over time they looked into things and started to believe, okay, no, I understand this is an opportunity, and I'm willing to work with Simply Solventless to make sure that the balance sheet is as strong as possible, and then they can capture upside. And of course, we've come down in price from the 50 cents, but I guess long story short, they're believers in what we're doing going forward.
Mm-hmm. Awesome. These paid-in-kind transactions being non-cash, do you pay an excise tax on them? If so, will this taxation now be different?
No, those are non-excisable. So those are basically B2B or tolling service transactions, which aren't subject to excise. The only transactions subject to excise are the sales to the provinces of the CPG products, or medical is actually taxed as well.
Mm-hmm. Gotcha. Okay, so Mark says the market clearly didn't take the accounting changes well. It's shaken investor confidence. Do you have a plan to win that trust back? And aside from this meeting with our SED group, is there anything else in the works to reassure the market?
Yeah, and so of course, results is what it all comes down to, and so Q1 for us is really the first gating item to start to rebuild the confidence in the trust. Of course, on the acquisition strategy, we're not going to pursue acquisitions if it's not accretive on a per share basis and our cost of capital suffered. So it's really going to be about results. It's going to be about demonstrating cash flow from operations and doing good commercial arrangements and deals that help build the company and build revenue. And we have numerous deals in the works. commercially to help increase revenue that we're quite excited about. And so, you know, in the next month or two, it'll be essentially just demonstrating that, you know, the accounting treatment affected 2024, but it's not going to affect 2025. And if it does, that it's going to actually be for the better. And that, you know, we're able to generate cash flow from operations and work towards cleaning up the balance sheet. And you know, I think it'll take some time, of course, but that's what, you know, that's what we plan on doing. And of course, demonstrating management's commitment to Simply Solventless and doing everything that we can as a group to facilitate our success and demonstrate that, you know, we believe in the story. I think will be important as well.
Very good. Thanks, Jeff. Joseph asks, are you or anyone at Hash still talking with cannabis's representatives, such as the McIntyres? Is the likelihood of M&A transaction of Can-B and Hash basically zero? What can you say there?
Yeah, haven't talked to Can-B at all, other than sending the demand letter for the 1.2 million break fee. And you know, that's an interesting point too, because the timing of everything was horrible. I mean, obviously, just with basically we got the letter from the auditor that the audit would be delayed, and the Can-B termination letter within hours of each other. But the fact of the matter there is that I didn't even know about this issue and the revenue recognition issue being so significant until basically we got the termination letter. And so what I'm saying is that there's no way that they knew about it, and there's no way that they knew about these accounting treatment changes or anything like that. So in that regard, all I can really say is we've sent the demand letter, and we believe that we're owed the break fee. And the chance of a M&A deal there, I would say, is remote.
Mm-hmm. Mm-hmm. Okay, so Paulo says, would you be open to selling the company?
I mean, we're always open to something that would generate value for our shareholders. Obviously, you know, at this valuation, I believe that we have a lot more opportunity to create more value and to achieve higher levels than this. But of course, we would look at anything that, you know, would provide the value to our shareholders, where maybe we can participate in upside of an acquiring entity. But honestly, right now, you know, and this has always been our mantra, is that if you build a business that's you know, profitable and that has fundamentals that and you're designed to be around in perpetuity, that those are the companies that get acquired. And so I think, you know, for us, if we just demonstrate over the next few quarters that you know, oh, this, you know, this does make sense now, what happened on these accounting treatments, that it is unwinding, and you know, the trust is being built again. You know, if we focus on that and running a good sound business, then, you know, those opportunities may come, and we'll evaluate them on a case-by-case basis.
Mm-hmm. Great, thank you. Okay, so Greg says, since Can-B acquisition didn't work, does it mean you'll have extra CapEx now? Okay, so maybe answer that question, and I'll give you the second part.
Yeah, no, not necessarily. I mean, one of the items that we found attractive about Can-B was that they did hydrocarbon extraction. You know, we were about halfway through bringing hydrocarbon extraction into our Calgary facility. So we'll likely advance that at some point going forward. But that CapEx is not material. You know, we're talking maybe not even 500,000 more to get that going. And so, and aside from that, there would be no other CapEx requirements that we would need or you know, that we'd have to manage.
Gotcha. Do you hedge against potential price drops given the time it takes to turn over the inventory?
No. And so one of the good things about bubble hash is that essentially its shelf life is, I mean, you can't say indefinite, but it's frozen, and it has a very, very, very long shelf life. And that's why it's generally stored as bubble hash and not converted to other products until you know where it's going and have a market. And so we actually, you know, we're long cannabis. We obviously we see the supply chain tightening on the flower side, and that includes the outdoor flower side, which is the predominantly used in extractions and ice water extraction for solventless. And so with with that dynamic changing and it becoming harder to come by flower, we're long cannabis. We believe that prices over time here could or should increase. Barring any behind pipe production, so to speak, for anyone from oil and gas. But a lot of these facilities have been shut down, and so how long does it take them to get turned back on again, and how much production is behind pipe? There's material production behind pipe, but I don't think most of the facilities that have been shut down will be reactivated. I think that there's been a balance demonstrated in the market now, and an equilibrium has come, and if anything, that should pressure prices upward on extract products.
Yeah, agreed. Given the recently increased cost of capital, as investors looking in from the outside, what type of metrics should we look for to monitor progress going forward? Given previously it was favorable acquisitions, revenue growth, and profitability. Is there something else investors should kind of watch out for?
Well, I mean, profitability, it has to be one of the most important things, and it is the most important thing to us still. Of course, our 2024 statements certainly don't demonstrate profitability, but I don't believe personally that they're reflective of our profit. I mean, we don't have a 13% margin in my view. And so that's really, I think, the key to our profitability narrative is that 13% gross margin is tough to explain. And certainly when we're making sales, we're generating much more than that. So we do believe we're a profitable business. Of course, we're going to have to demonstrate that, with the new accounting treatment, that we are profitable. We'll look to do that. And then of course, beyond actual profitability and net income profitability, cash flow. Cash flow from operations is going to be top of the list. And then ultimately free cash flow and generating a strong, sustainable, fundamentals-based business.
Gotcha. Curtis asks, any thoughts on getting Q1 results audited?
Certainly I've thought about it. Of course, we would be delayed again in that case, and we'd probably, which auditor, I guess, would be a question. But, ultimately, we've very much, thought about that. I don't think it's practical. Perhaps at some point we could look at getting them looked at once we've filed them this time and or something along those lines. But, it's just in terms of timing, it's not practical. And I understand why that would be a question and why that would be attractive to do. I wish we could, to be honest. But we don't have plans to get it audited. We'd probably be, I think, the first company in the history of the world to have a quarter audited. But I think it would help.
Yeah. Paulo asks, would you be open to a raise?
We're always open to financings, but clearly the dilution would be significant. We don't want to do a disservice to our current shareholders, but certainly they would have an ability to participate. So I think realistically, we're not going to look to do a financing in the immediate term here. We need to turn the ship around, get the momentum going in the right direction, get Q1 out, and of course we would look at things. Balance sheet strength is very important to us. And so, over time we may consider it, but we're not running to do a dilutive event at these levels, certainly. And we'll do everything in our power to avoid any kind of dilution at a level like this.
Gotcha. Tegan says, as we look forward to your Q1 results, can you comment on the expected accounting? How comparable will Q1 2024 be to Q1 2025? Will Q1 24 be adjusted, restated?
And so, we had desired to actually kind of look at 2023, of course, even as well, and that's we're looking at that. We don't have a plan to restate Q1 2024 at this point. And in terms of comparability from Q1 2025 to 2024, I would say, it's not going to be all that comparable. Just because we had the elevated COGS in 2024, it makes it pretty tough, honestly. And so I hate to say it, but I don't think the highest level of relevance will be there in the statements and from a comparability perspective for Q1.
Mm-hmm. Like on
Except
a
margins should be, right? Like, like Q1 as it sits, as it's filed, should be comparable in terms of margins to Q1 2025 and things like that. And certainly the revenue growth overall will be demonstrated between on a quarter, on a Q1 2024 to 2025 basis. But in terms of the whole year, the Q4 2024 to Q1 2025, I think it's going to be tough to have comparability there.
Yeah, fair enough. I imagine you're going to have a lot of work trying to explain it through in the news release, maybe for MD&A as well in Q1.
Yeah, absolutely. Yeah. I think as much color as possible, something we're going to have to strive for and give as much information as we can so users can, make sense of it.
Yeah. Speaking of Q1, I mean, do you see any issue with hitting your timeline? I think it's June 20th is when you expect to release. But
at this time, no. We should be able to make that.
No problem. Okay, good. Pablo says, how's business with the products? Will there be organic growth?
Yeah, and that's a focus all the time for us is driving organic growth, and we think with the brands and the assets we have, certainly we can drive strong organic revenue growth. So given our cost of capital has gone way up and our valuation is where it is, and maybe the M&A is going to pause for a while, the organic branded revenue growth will be top of our list.
Sarah says, are you exploring the opportunities to sell the flower in international markets for higher margins through Humble Grow?
Yeah, and so the flower from Humble is going internationally currently. It's a GACP facility, so that means we need to basically sell it to a GMP facility either in Canada or typically in Europe, and then it goes to the markets direct or from there. But absolutely, the international market is very attractive. The domestic B2B market is also solidified quite a bit here, and we're receiving fairly attractive prices. So we're looking at getting our Humble facility GMP certified, and so that we can go direct to Germany as an example. And so the answer is yes, and hopefully more so going forward.
HO says, do you think obtaining the 1.2 million termination fee from Canby is realistic? Could pursuing it cost more money in the short term?
I'm not going to say it's not realistic. Of course, I don't want to do that, but I will say, it's I think gaining trust back and focusing on our business and driving the cash flows is the priority. At some point, it's something that we'll probably look at pursuing, but it's not going to be our focus at this time.
Russell asks, if Canby had figured out within their due diligence that there would be need for accounting changes and the results of that, would that have been a viable reason to cancel the deal?
Honestly, I don't know, but I would be shocked if they came to that conclusion.
Okay. Greg says, do you
sorry, just to be clear too, like they hadn't even seen drafts.
Yeah.
They hadn't seen financial statement drafts for 2024 or anything like that. So coming to that conclusion would have been incredibly difficult.
Especially since 2023, same service, same sort of procedure there wasn't an issue with, and that was audited. So yeah, I agree with you there. I have a hard time believing they could have come to that conclusion. Do you expect cash flows to lag behind net income going forward? Can those eventually catch up?
Yeah, and so I guess, kind of what I was alluding to before is that I actually believe now that cash flow could lead net income to a degree, just because we have an attractive cost base on our inventory now compared to before, and we can really attack these markets and sell bulk B2B bulk product. And so, our desire and hope would be that we're monetizing more inventory that we're building now, and that it's contributing to cash flow from operations as opposed to taking from it. And so in that regard, then it would lead net income.
Mhm. Gotcha. Patrick says, why did you not, why did you not do an earnings call to explain the issue?
Oh, that's a good question too, and a fair question. Ultimately, as we were proceeding through things, we were just in the thick of it and didn't even ultimately know when we were filing. Of course, we had delayed and then delayed again, and so kind of needed to make sure we got filed and got it out there. Obviously, we were also working very hard on the ANC deferral and restructuring of those 7.15 million of prom notes, which was a huge important piece of business for us because we had 3.65 million due in at the end of May. And so I think, I completely agree with the sentiment there that an earnings call would have been useful. It's something that we just ultimately couldn't get ahead of, and so here we are today as kind of, I would say, the first step. It's important to connect with the small cap investors and community, and we'll look at seeing what we can do broadly going forward.
Mhm. And last question I've got here, any thoughts on eliminating, sorry, there will be another question. Any thoughts on eliminating guidance forever?
And so that's a tough question as well, because I do believe in guidance. I believe in being communicative with the investing public. Of course, did I anticipate a significant change in accounting treatment? Absolutely not. And so, in this case, obviously it didn't help, but I I would like to continue to be communicative and transparent with the market on what our expectations are, and to set targets and then to be held accountable. So it's something we'll discuss internally. We may have to, pare it back a bit on the guidance. But at some point I would say that it would come back, and we'd want to do that.
Gotcha. Gote says, in hindsight, do you think your past revenue recognition practice was a bit too creative? What precedent was there for accounting this tolling services in that manner?
Yeah, so I mean there's tons of precedent for it. It's not a novel way to account for in-kind payment. And for us, like, the foundation is that we wouldn't have done deals like that. We wouldn't have just purchased that quantity of flour, right? So, like, for us, we didn't believe it was creative in terms of the accounting. It's a standard accounting practice. It's thoroughly documented in the IFRS guidance on how you account for in-kind transactions, and so I think it had been audited multiple times even before we ever accounted for it in that manner. Back in 2022, we had discussed it with our with auditors and even third party people, and so I don't feel like it was a creative accounting treatment by any means. But when you're doing those types of arrangements, subtle changes can change the accounting treatment, and obviously we've learned that the hard way.
Dom asks, could a conference call still happen here? A lot of investors in the company aren't SED members and would love to hear your view.
Yeah, we'll look at doing that. I mean, obviously, we want to do everything we can to engage with our investors and make sure that everyone's fully informed. And so, we'll look at doing that. We'll discuss it internally.
Perfect. Paulo says, were you surprised to see the shares down 60%?
Yeah, I was. Yeah.
Sean,
Especially
yeah.
considering, sorry, but especially considering, like, I guess on one hand, I wasn't surprised. Obviously, it was a fun, a large change in accounting treatment here. So I fully appreciate that and understand. But, I then, on the flip coin of that, you have the ANC former shareholders taking shares at 50 cents. And I certainly, personally believe that our value proposition is much more meaningful than our current levels. And so, I guess, in summary, I on one hand, I'm not surprised, and on the other, I am. And it did go down 60%. And so now what we need to do is, start to build the momentum and the trust and get the ship going in the right direction again and demonstrate, that we have a strong business here that's capable of strong value creation and growth, and whether that's organically or, with the cost of capital through M&A.
Sean asks, what is the biggest opportunity for Hash coming out of the recent challenges?
Sorry?
What is the biggest opportunity for the company coming out of the recent challenges?
I would say honestly, the attacking the B2B wholesale markets, kind of expanding our solventless sales into the B2B market, whereas they've been essentially exclusively CPG focused to date. Obviously, just running lean, making sure that we're rationalized and we're focusing on cash flow. So there's opportunities at hand, and we believe there's a strong runway for growth here, and from these levels certainly to create value. And so that's we'll just get after it.
Joseph says, is doing a pre-release, for instance, rough figures announced in the first week of July for QE June, is that more useful than doing guidance? And he then goes on to say, I'm also interested in to hear Paul, Andriola, and or Trevor's philosophy on this as well as Jeff's. Maybe what's your thoughts on that?
Yeah, and so typically we had provided guidance once we had a pretty good picture of the quarter. Typically it would be we'd either have 2 full months or even 3 months in the books and a strong degree of confidence in what we were guiding, of course. And so I almost look at it as the same thing because of that. Whether you're doing like a pre-release or a guidance, it's based off the same information. And I guess if you leave it too long, then you might as well just wait to file.
Mm-hmm.
So I guess that's the balance that you're kind of running into is, do you do guidance pretty early and provide some direction for investors, or do you just wait till you file? And so we had chosen previously typically to give guidance in a couple of weeks before the quarter ended, so that we had a good understanding of the numbers. And we'll look at that going forward. And yeah, I'm equally interested to know Paul and Trevor's thoughts on that.
I certainly believe that once you start, it's hard to stop. If it always looks unusual when you stop for some reason, it's usually a sign that things aren't going the way you want to guide. But it's a catch-22. Like in an effort to be more transparent and give out more information, are you complicating it a little bit by doing it? So I'm not really strongly in favor or against it. It's just you have to stay consistent no matter what you do. That's my view. You get punished once you lose consistency, no matter what. So so that'd be my thoughts. Okay, and it looks like the last one is more of a comment, and I agree. Nick says, thank you, Jeff. Appreciate you taking the time to explain the situation and take our questions. Clearly, I understand this can't be an easy time for you in the business. I know from personal discussions with you, you are all in on this. This is clearly something that you've got a very large vested interest in seeing succeed, as well as a lot of your management team and other players here. So I can't thank you enough for joining us today and explaining what clearly is confusing and challenging enough for those that know accounting, even more so for us that are neophytes when it comes to this sort of stuff. So on behalf of everybody at SED, Jeff, I want to really thank you for coming out and explaining this. If anybody's got more questions, what do you think is the best way they can reach out to you?
Probably, send me an email, or call, of course. My email is jeff@simplysolventless.ca. I will answer every single email that I receive. And I thank everyone for coming to the call today and wanting to gain some insights on what happened here. And from our perspective, we're just, resilience is one of our core mantras. We have to be resilient now, and we're going to do absolutely everything we can to be resilient and to drive forward for our investors and our stakeholders. And we thank everyone here for participating in our story and for any support that you can still give. And in that regard, we're going to do everything we can to rebuild your trust and move forward and show that we're a viable, strong business, that we're wanting to create value for our shareholders, and that that you can trust us and move forward with us. And so thank you everyone so much for giving me the opportunity to discuss this today.
Mhm. I think it's a fantastic way to end it right now, Jeff. Appreciate so much your time. I know these are trying times, and the tough managed to make it through this sort of stuff. So appreciate it, and we'll look forward to catching up pretty soon. I'm sure we'll get another call with you shortly after Q1. So look forward to that as well.
Yeah, me as well. Thank you so much, Paul. Thanks, Trevor, and thanks to everyone.
Thank you. Bye for now, Jeff.